All right, guys and girls, I got a good one for you today. This is the principles of financial planning, and we are going to use Python. Of course, all my demos consist of Python code, and I write out all the code and then run it for you can see, so you can see in real time how everything works. And then I have a bunch of notes. This is the standard format they came up with. I think this is useful. I haven't had any complaints. I haven't had any real positive feedback either. Maybe just a little smidge, but not a lot of positive feedback. But I think this makes sense, so I'll stick with this at least for the time being. So financial planning basically helps us to understand where we are at this point in time with our personal finances and then where we want to be in the future. So there's basically 5 pillars of financial planning. You'll have tax planning, insurance planning, investment planning, retirement planning, and estate planning. That's the fifth one. Okay, so I think all of these are pretty straightforward. I struggled a little bit with the estate planning exam when I took these tests, but I still passed on the first try. So yay for that. And this is not comprehensive by any means, but this is a good intro course, I think, to financial planning. What is it? How does it work? And it will touch on these 5 major topics and a few other subtopics as well. And of course, everything is in Python, so you can play around with it. You can modify the code to suit your needs and just roll up your sleeves and get into the code, dig around a little bit, and see how this stuff really works. So I think it's pretty interesting. Let's get to it. So why are we interested in financial planning at all, right? Why would we even touch on this type of subject matter material? There's a bunch of reasons. Basically, to improve financial control of our personal situation, to achieve our financial goals, to save for an emergency or to prepare for the future, right? Better risk management, tax efficiency. You should pay as much taxes as you are legally required to do, but not a penny more, right? So if we can minimize our tax liability legally, we should be go ahead and do that. Increase savings and investment, debt management, peace of mind. That's important, right? Retirement security, legacy and estate planning, better financial habits, adapting to life's changes and crises that come up at a moment notice, and maximizing financial growth. Okay, and there's probably a couple other things, but I think that touches on the major ones. So, personal financial planning for budgeting, this is the first topic we're going to look at, involves creating a detailed financial plan around income and expenses, and this ensures stability of your financial needs. Okay, it allows individuals to allocate resources effectively and prioritize spending and track your progress to make sure that you are on course with your investment strategies, your investment targets, right? That's very important. I think Einstein said something like, um, compound interest is the eighth wonder of the world. That's it, more or less. I think it's probably exactly it. So, if you start saving earlier, you can save a lot less and you can still potentially have a lot more retirement. If you wait much longer in life, like 20 or 30 years, if you kick the can down the road in the latest, you're going to have to save a lot more money in the end to meet your target, right? If you do more at the beginning, overall, it's going to be a lot less contribution on your part. If you don't do anything until it's too late, then it's basically too late and you totally missed the boat, right? So let us take a look at this. I put together some Python code yesterday, refined it just a little bit this morning. So we have some inputs we're going to request from the user: income, rent, groceries, utilities, transportation, entertainment, and savings. Okay, and based on these, what is it, 4 or 5? What are they saying? It's maybe 8. I want to see how well we are equipped to prepare our financial plan and where everything sits when we input the numbers here. And it made this very dynamic, right? So I could hard code all these numbers. I could say income is whatever, 10,000, 2,000, can be $20,000. Like everybody's gonna be different for your personal situation, right? So I made this very dynamic so this can appeal to anybody. So enter your monthly income. Again, it's not hard coded. We're looking for input from user. I'm gonna say 10,000. Some people could gasp. They're like, "What? That doesn't make any sense." But I live in New York City. 10,000 is fairly common. You can see people making more than that. You could see 50,000, 100,000 in 1 month. Okay, I'm just using this as an example. I think in New York that's somewhat realistic. Monthly rent, I'm going to put 4,000. Okay, this is just my scenario. Give or take, I mean, it's a little bit different, right? But again, I tried to make this dynamic and flexible to accommodate everybody's needs. Grocery budget, maybe 250 per month. Might be a little under. Let me put 300. Even that might be a little bit low in New York. Monthly utilities, that's not too bad. 200, I'm going to say. Transportation, I'm going to say 150. And then monthly entertainment budget, oh, that could be anything. That could be pretty low, 50, $100 up to thousands. I'm going to say 300. I'll just say 300, whatever. And how enter how much you will put into your 401k per year. Okay, so again, this is going to be different for everybody. That's what's an input. This is going to be very dynamic to capture all the possible scenarios. I'm going to say per year. So these other, if you're paying attention, these are monthly. This is per year. I think the maximum is 20K or 22K now. Over a certain age, it's more. I'm going to say 18,000. I know I don't put 18,000 in, but should. Okay. So we put in the money and we see the monthly budget scenario. Okay. So here's the income. I put in 10K. Now I'm saying in some scenarios it might be a little bit lower, in some it might be a little bit higher. So I'm multiplying my income. The blue is the original scenario. The red is the blue times 0.9, and the green is the blue times 1.1. So I want to take a haircut here or chop off 10%, and I want to add 10%. So here's my income, here's my rent, groceries, pretty inconsequential, transportation, entertainment, and then here's my savings at the end of 1 year. 18,000 is most likely. Oh no, I'm sorry. 18,000 was the amount I put into my 401k, and then if I get squeezed a little bit, I can't put in that much, 16.2, and then if I have a good bonus this year, 19.8. Okay, so just basically budgeting, just so you see visually how everything shakes out here. I think that's a good exercise to undertake. Okay, so personal financial planning also involves saving and investing. We just saw budgeting. Let's take a look at saving and investing. It requires evaluating your personal financial goals, your risk tolerance, time horizon until you tap into your investment. You choose an appropriate investment strategies too, right? So some people are going to be a little bit more conservative, some are going to be a little bit more aggressive. That's fine. It's whatever makes you comfortable. If you are not comfortable in certain investment types of investments, equities, or very volatile stocks, you could pick something more conservative, maybe a mixture of CDs and some bonds and some stocks. It could be a bunch of different things, but you have to be comfortable with your preference for risk. Some people have an appetite for more risk. Some people have an appetite for less risk. Okay, so you know what you are. You have to comply with that. Otherwise, you're just going to be uncomfortable all the time, right? You're going to be afraid you're losing money, or you're not making enough money, right? So it's really a personal decision. So let's look at savings and investing. Again, I'm going to capture some inputs from the user: savings, number of periods, number of years, and then growth rate. And let's look at the scenario. So hit Control Enter to run it. We go down here, and a lot of this is just plotting the chart and so on and so forth. The major things come from here, the inputs from the user, and then we're doing some basic compounding over here. Okay, and then any kind of adjustments go over here. Okay, so that's it. Pretty straightforward. I'm going to share all this code with you guys, so you don't have to take notes and you don't have to write it down on a pencil and paper. I'm going to share all this with you when I post a video later today. So enter savings amount per period. Let's say, I'm going to save $1,000 a number of periods in 1 month, 12 times a year. So number of periods per year, 12. So I'm going to save $1,000 per month, 12 months in a year. Number of years of savings, I'm going to pick 10. Okay, so we're going to save 10 times 12. This is 120 periods of savings. Okay, so 1,000 times 120, what is that? 120,000. Enter the growth rate as a percentage. Now I'm going to pick a number here. It's almost guaranteed it's not going to be the same consistent for 10 years. Okay, it's going to go up, it's going to go down, because this is invested in the market. You can have good years and bad years. I'm going to say overall 5%, probably low. We'll probably exceed that threshold of 5%, but I think it's somewhat realistic. If you put in 2%, it's too low. If you put in 25% for 10 years, it's way too high. You're not gonna get that. Okay, there's gonna be bad years mixed in there. Okay, so here's our chart, and we have our savings over here. So the original savings was in yellow, and then take a haircut for the reds. Okay, so the reds look like this. If we zoom in, we have 174K, 176, so it's gone up a little bit, 178, 181, 183, and this red over here goes up to 185. Double click to get back to the original chart. So there you can see it goes up consistently and persistently. In reality, it's going to fluctuate a little bit. Okay, you can have good periods and bad periods, good years and bad years, good months and bad months. But this basically shows you what you can hypothetically expect over the course of time. Now, I should probably put in like some kind of randomizer in there and just make it a little bit more realistic because it's not going to increase consistently like that over time. There's going to be bad periods that drag down your portfolio, but um, let's leave that as an exception for right now. We'll just look at this. So the original savings in year one is this. This would be a lower cost scenario or um, lower interest scenario. Okay, you can call it whatever you want. And this is year two. This is period 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. I think we had 60, right? Let's get down to the end because wait, we had 12 times 10, 120. Oh, there it is, 120. So we put around 1,000 a month into this investment at 10 years. We have 195,000. And we put in basically, if you think about 120,000, so 195 minus 120 is about 75,000 in profit. The somewhat less risky alternative would be 185, and a more risky outcome would be 205,000. Okay, so that's how that works. So retirement planning is just straight up comprehensive retirement planning. Like we touched on budgeting, we touched on investing. Retirement planning is somewhat similar to those, but a little bit different, right? We basically need to save money to invest in the future to be able to accommodate the lifestyle that you want to engage with after you stop working, right? So it involves setting clear financial goals, estimating future living expenses, and considering factors like inflation, healthcare costs, life expectancy, and so on and so forth. Okay, and we have a few investment vehicles that can help us get there, right, to achieve our goals. 401ks, IRAs, there's SEPs, simples. There's a whole bunch of them, right? Some people qualify for some people don't qualify for some. So you have to see what you're eligible for. But in this scenario, we're not looking at SEPs and simples and IRAs and alphabet soup types of things. We're just looking at a retirement savings account, okay? And we're going to consider factors of growth, risk tolerance, and the timing of withdrawals to ensure that our financial goals are met to the greatest extent possible. Okay, so again, we have our inputs, starting balance, annual contribution, current age, retirement age, rate of return, and then the marginal tax rate. Though we're all paying taxes, you can't ignore taxes, you can't ignore inflation. These things aren't going away, so you might as well just accommodate that and bake that into your analysis. Otherwise, you're going to come up short, right? If you don't accommodate for inflation and for tax consequences that you will be subjected to no matter what, you will come up short. You might think, okay, all I need is 2 million to retire. Once you incorporate the taxes and the inflation, you might actually need 2.5 million, right? So let's get realistic here and bake those into the analysis here. So enter the savings amount per period. I'm gonna try like before, 1,000. Annual contribution amount 12,000. I put in, whoops, yeah, well, not 120. That I wish that was it. So enter the annual contribution amount. And okay, so we start with 1,000. We put in 12,000 per year. So the 1,000 is just to kick it off. Enter your current age, right now 52. Yep, believe it or not, getting up there. Retirement age, I'm going to say 70. So I've got 18 years to go. Enter the expected rate of return. I will do 8. 8 is good. Over the next 18 years, I think 8 is fairly realistic. Marginal tax rate, probably 20%, probably give or take. When you're retired, your income dips and your marginal tax bracket is going to decrease, right? If you start taking money while you're still earning, if you start taking money out of your IRA or your 401k, I think you can. I think it's legal, but you really wouldn't want to touch it until you've stopped working. Because with some of those things, you can actually pay a penalty. Like if you're taking money out of the IRA, I think you could after age, what is it? 65 and a half, I think, or maybe 67 by now. They increase every few years. And I think by 70 or 72, you have to take it out. And the 401k is a little different. You're penalized If you're working, you take money out, so you wouldn't touch that until you retire. Let me put 20% for taxes. And here's the breakdown here. So we have total savings. You can see that's accumulating right here year over year for 18 years, 489,000, not bad. Almost a half a million taxable savings. Because this isn't a tax deferred vehicle, either an IRA or a 401k, they both offer tax deferred benefits. Your taxable savings is almost 100K. So we're saved 489. If I put the mouse over the bubble, there's that. And this is 97,870. And that's what you see there. Okay, so very nice. You can see this is the bar chart. This is the line chart increasing year by year. So 52, we start, this is 1 year out. It's always 1 year into the future. And then we stop at 70. So I see 489 that corresponds to this over here. And tax savings is kind of hard to read at 97K. That's what you see right there. So nice. So this is working excellent, just what we want. So now let's take a look at risk management. We've touched on a couple different topics of financial planning. Risk management pertains to a specific part of financial planning. Let's take a look and see what this is. Basically, we're identifying and assessing mitigating risks. Potential risks include negative impact to your financial well-being. Okay, if you have a catastrophic event, a car accident, a medical emergency, home burns down or gets destroyed by who knows what, a tsunami, a tornado, hurricane, or something like that. Your entire working career could be invested in your home, which is a major asset for most people. That's the number one most valuable asset. Could be wiped out very quickly, and in the blink of an eye, most of what you work for your career is gone. So you really want to have homeowners insurance. You want to have life insurance while you're working, earning income for your dependents. If you have stopped working and your dependents have left the house, now they're in college or post-college, they've graduated, you don't really need life insurance because that person or those people are not dependent on you anymore for financial gain, right? Or financial income, whatever you want to call it. If you lose your job, well, you have a disability that could affect your income stream severely, right? So disability insurance might be something that you should consider. You might have this through work. If you work for yourself, you might have to get a self-insured, not self-insured, like a separate carve-out plan or something like that. All right, so there could be a bunch of risks that we don't want to underwrite by ourselves. We would want to offload this onto some type of insurance entity, right? Or some type of pooled insurance type of product, right? So let's take a look at this. We have risk management, life insurance. Here's the base rate, age factor, okay, and the term factor. And again, so these are real inputs, user inputs like I got before. This you'd have to put in for yourself. I'm saying 35, 20-year term. You could set this up as user inputs. I just did not. It's just a slightly different way of doing it. But again, you can put in whatever you want here. You just change this number. Unemployment insurance, if you want 60,000 coverage, this is what it would cost you most likely. But shop around, right? Because all these insurance companies offer different rates. Sometimes they want your business, so they'll have a lower premium. Sometimes they don't want your business. So to discourage you, they will offer higher premiums. Say, hey, if you want to be a sucker, we'll take your money, but we really don't want your business. We're not focused on that line of business, and we're not interested, right? So you have to kind of shop around and find the thing that suits you the most. So here we have disability insurance, and again, some hard-coded numbers. You can set this to whatever you want. It got a little bit complicated when I tried to capture all the user inputs because we're doing all of this insurance like comprehensively at one time. If I broke it down into a bunch of different cells, you could certainly capture user inputs, or you could do it in this one large cell right here, the cell in Jupyter Notebook, but it gets a little bit convoluted, and I just thought this was not, like, just neater, cleaner to do it this way. Okay, here's homeowners insurance. We have base risk, base rate, location, premium, and total premium. So let's go ahead and call all these functions. Okay, here's life insurance premium, and we're going to pass in those values. If I do Control F and go over here, there's the name of the function, right? If I go this, unemployment insurance premium, Control Paste, and overwrite that and go down, you see the next function is called right there. Okay, so let me go ahead and Control Enter. And again, if you want to change this, you go ahead and you manually make these updates right here or here. Pretty straightforward, right? So we're saying the life insurance premium is $5,555. The unemployment insurance premium is $1,200. disability is that, health insurance is that, and homeowners insurance is that. So let's plot this down here, Control Enter to refresh the plot. Here is life insurance, unemployment. So here's the breakdown. The visual looks nice, I think. I always say a picture's worth 1,000 words. When you look at this thing right here, okay, that's nice. That's all um, true, right? But how does it look visually? I don't know, right? But if I plot it, then I know. And you can see easily life insurance is more than half of the total costs of the premiums for all the insurance. And here's the breakdown for the others. Health insurance is, oh, disability is the least. I thought it was health insurance. So disability is the least. And here's the others. And these plotly charts are pretty nice. If you click on this, you can expand it and explode it into different views, right? And then you can get the whole breakdown right there. So that's pretty nice there. So how about debt management? Let's talk about debt management for a minute. This is another part of your financial plan that involves creating strategies to manage or reduce debt in a way that aligns with your financial goals, right? So the less debt you have, the more capital you can save, right? And the quicker you're going to achieve your financial goals. So debt management should be a priority in any financial plan, okay? We're talking about credit card balances, student loans, mortgages, and any kind of debt that has some cost associated with it, which is almost everything, unless you have a 0% credit card, and those are just temporary. It only last for a year, maybe 18 months, 2 months if you're, 18 months or maybe 2 years if you're lucky, but beyond that, you're not going to find those. And those things are pretty rare too. So most people pay debt, right? So ultimately, the goal of debt management is to maintain decent financial health and ensure that debt does not hinder you from achieving your financial goals. Okay, so let us go ahead and capture some inputs from the user. Okay, just like we saw before the insurance example. Enter the loan principal. So how much are we going to borrow? Let's say it's a home loan. We're going to buy a house, 300K. Now, in New York City, nobody's buying houses for 300K. That doesn't exist. But let's say outside of New York City, this could be a realistic example, although home prices seem to have appreciated pretty significantly since the beginning of COVID. So even this might be low, but you know what? Let's just go with it. I think for our illustration purposes here, I think it's fine. Annual interest rate on a loan, let me put 7.5%. I think that's pretty realistic. The monthly payment amount, how much are we going to pay on this loan? Let's say I want to get this thing paid off. I'm going to buckle down and save money and try to pay 5,000 per month. Okay, it's aggressive, but let's see if we can do it. And we get down to our colors here. So everything's plotted out. We got 300K. You can see it's going down. It's decreasing lower and lower and lower and lower and lower. Into month 62, we have 64,000 outstanding. And then it goes down to just about 1,000 here right at the end. And then we pay off the loan after month 75. Okay, so there it is, months to pay off loan, 76 months, and the total interest paid, $77,000. Okay, so it sounds like a lot, but it's actually over, how long was this? 76 months, 6.5, that looks like 6 years. I think it's about 6 years. So you paid 77,000 over 6 years, just over 10,000 per year. But let's say you bought the house for 300,000 and it's appreciated over 6 years to 400,000. So you paid 77 for the interest on the mortgage, but that interest is tax deductible, so it might be closer to 50,000. And if your house is worth 40,000, I'm sorry, 400,000, you made a $50,000 profit just for doing nothing, just for living in a house. You made 50,000. Congratulations, pat yourself on the back. So even though this looks like a big number, it's kind of intimidating, it's kind of scary. Mortgage interest, if your house is appreciating in value, can be really your best friend in the world. Probably your house can be one of the best investments that you'll ever have in your entire life. So let's switch gears now and look at tax planning. This is another crucial aspect of financial planning, like debt planning, investment planning, retirement planning, budgeting. All these things are important, right? They all work together congruously. They're very congruent, right? So by understanding the tax laws of your local municipality, you might be able to you might be eligible for certain deductions, credits, tax efficient investment strategies, all kinds of things. Solar panels on your house, you could receive a credit for that, really. So this is a case by case basis. You really have to understand some basics about tax laws. And this, again, this this lecture that I'm doing now, this is not comprehensive. It's not a super deep dive or anything, but it's just a general exposure to a bunch of different topics in the world of financial planning. That's what it is. So we can't get into all the tax planning nuances here. My brother-in-law works as a tax attorney, and he's up to his eyeballs of work, and he only does tax. He doesn't work on estate planning, budgeting, financial planning, retirement planning, anything like that. And he has his hands full, right? So taxes are just a beast all on their own. But I think this is a good overview of how to be aware of your tax liabilities and what you are required to do. Okay, and then if there's some tax loopholes, by all means take it. If there's a way to um, reduce your tax liability, by all means take it. Anything that's legal, you're entitled to do. You can't do things that are illegal. But if you are eligible for it and you don't take that tax credit, you're just leaving money on the table, right? So you should be informed and knowledgeable about what you're entitled to. So here we have income, deductions, and credits. I'm going to run this. We have inputs from the user, just like before. So we have enter your income. Let me look at this a little closer now. I forgot what is this? This is income. Okay, let me see. My income is like 100,000. And enter your deductions. Okay, let's say I'm entitled to 20,000, and deductions, your personal deduction, deduction for a child or a dependent. You could have some charitable donations, donation to your church, things like this. Let's say it's $20,000. Okay, and any tax credits. Let's say we get another tax credit of $10,000 for some solar panels we installed on the house. Okay, so here's the breakdown. Taxable income is actually 80,000. It's 100,000 minus the 20. Tax liability is 90,000, right? Because we got a tax credit of 10,000, and let me see here. The original was 100. We got this down by the 20, right? So now we're down to 80. Tax liability is only 9 because you're paying 9%. 9 times 2, 72, a little over 9% on the 80,000, and the remaining income is the 100,000 minus the 9,000. Does that make sense? Okay, so you started with 100,000, subtract 20, because we had these tax deductions. Tax liability is 9, subtract 9 from 100, you have 91,000 remaining income. So taxes are scary, but honestly, like, you're getting 91% of your money. So not a bad deal. Like, everybody has to pay taxes. You have to pay for garbage cleanup, for police, fire protection, for the municipality to plow the roads in the winter, to pave the roads in the summer, and so on and so forth. Parks and recreation, maintenance, if you live in an area that has that kind of thing. So the taxes go for a lot of things, but if you make 100,000, only pay 9,000. If you think about it, it's not that bad, guys. Zero would be better, but that's not realistic. Okay, so this might be the last piece of it here. I think this is. Let me see. Maybe there's one more. This could be the last one though. Now we're looking at cash flow planning. This is the process of ensuring that all your expenses, income sources, and everything give you enough liquidity to meet your financial obligations while saving for your future goals, right? So your obligations are food, rent, mortgage, whatever the case is, utilities, transportation, clothing, things like this, right? But you still want to be able to save up for your future. If you spend all your money on current necessities, you're not going to have anything for the future, right? But you need some of these current necessities paid for, right? There's no free lunch here. So budgeting helps you identify the fixed and the variable expenses. Okay, so fixed is probably, like you say, mortgage is fixed, rent is fixed, right? It could go up at the end of the year, but during the year it's probably fixed. Your utilities might fluctuate a little bit. Clothing, groceries might fluctuate a little bit. So you have some fixed, some fluctuating costs. But basically, we want to understand the planning and make sure that this is essential for achieving our long-term financial stability and ability to pay our debt and prepare for unexpected life events. Okay, like having a child, there's damage to your house, lightning strike, or whatever. Right? Life is not perfect, right? So things come up, and we have to sometimes break open the piggy bank and make payments for things that we didn't expect. But that's okay. Financial planning is going to help us prepare for these inevitable uncertainties. Okay, so let's hit Control Enter. You run it, and we will gather the input from our user just like before. Enter your initial monthly income. Okay, I'm gonna say 10,000. It's not really, but I like that number. Initial monthly expenses. So I'm going to say the rent and the groceries and utility and all that. I don't think they parse it out at this one. I did the code yesterday. I already forgot what we're doing here. Enter the number of months for the projection. I'm going to say, 120 months. That's 12 months for 10 years, 120 months. Okay. And we see total income over 120 months at 10,000 per month. So 835, 1.18. So yeah, I think that makes sense. So it's about 120,000 per year. We're subtracting some out for expenses. Total expenses over the time period is 66,000. Total debt repayments, I said that is 0. Total investment contribution is 73,000. We're taking the difference between that and that, so we can put sorry, so we can put 73,000 into our savings account, and at the end of the 10 years, this is what we look like. We have the surplus that is purple, the expenses is red, and the income is in yellow, right? And it's increasing a little bit every year. So we get small bumps in our pay, little raises, and so on and so forth. So I think this is the last topic. Estate planning is a process of organizing and managing your assets during your lifetime and determining how they will be distributed after your death. We're all going to die someday. You, me, all of us are going to pass away from this world. We have the opportunity to prepare for it by doing estate planning, or you can ignore it. Ignoring the problem won't make it go away, so I think you should probably prepare for it. That's the sage thing to do. If you're wise, you're going to prepare for the inevitable. Okay, so the goal of this is to ensure that your wishes are honored, minimize the impact of estate taxes, and provide financial security for your loved ones after you pass away. Okay, so that's what estate plan is all about. Basically, consider potential estate taxes, try to minimize those taxes. And it can be substantial. If you do nothing, you're going to get slammed with taxes. There's stories about that. You hear it in the news all the time because people just fail to plan. Nobody in life plans to fail, but sometimes people fail to plan. Don't fail to plan because um, it's gonna come back. It's gonna come back and it's gonna bite you. So plan ahead can help reduce the burden of estate taxes. This will ensure assets are transferred efficiently to your um, to your loved ones and your, what was I gonna say, legacy survivors. Okay, all these people, and you will avoid disputes among heirs. Right, if everything is written up in the will, nobody can fight about it because that is a contract and it's non-negotiable. So here we have our estate planning scenario. We will collect some input from the user. Okay, and again, you don't have to worry about all the code at this point. A lot of this at the beginning is doing the compounding or the discounting. That's what this is. This is collecting input from the user. We're going to print the results and we're going to plot a small chart. That's what this figure is for. Okay, so I'll share all this code with you so you can copy and paste that into your own Jupyter notebook and run this and pull it apart, put it back together, and see how everything works. Okay, so here we are on the last part here, heading towards the finish line. Enter the inheritance estate value in dollars. Let's say 600K. Let me say 500K. Okay, my heirs were not as rich as I had hoped for. I'm the beneficiary. I'm going to get $500,000, not 600K. Enter the exemption limit in dollars. So sometimes you'll have exemptions. Some of it could come to you tax-free, but once you exceed a certain threshold, then you will have to pay. Okay, and there's exceptions. All states are different. All parts of the United States are different. It's really governed by state law. Most of this stuff, I think some of it might be federal law, but I think most of it is really controlled by the state. Maybe almost all of it is controlled by the state. Enter the tax bracket or the tax threshold. I'm going to say 20%, 0.2. It's 20%. It's going off the screen. What's it saying here? Please enter a valid tuple. Oh, I know why. Okay, let me do this again. Okay, so 500, 200 is exempt. So this is because we have a progressive tax in this country, that's what we're collecting here. I'm going to say 200,000. Okay, just and a comma 0.2. This is just a scenario. Whoops, 200 comma. Oh no, that was right. Comma 0.2. Okay, so we have a progressive tax in this country, so that's why we're doing it this way. This is a little bit different than just a straight tax. Enter any deductions, charitable donations, things like this. I'm going to say 50,000. I'm putting 50,000 into charity. So if I give this straight to charity, I don't have to pay taxes on it because I don't get to benefit from the asset. It goes straight to charity. If I don't touch the asset, I don't pay taxes on it. Enter the inflation rate. I am going to say 0.04, 0.04. Maybe it's a little bit low for today's inflationary environment, but kind of close. Enter the number of years for your projection. I'm going to say 20 years. I think that's fine. Okay, let's look at the result. Here's the chart. So the estate tax projection over time actually ends in 5 years. So because of the discounts over here, we got 200,000 off because we're under the threshold. We had another 200,000. Tax bracket is only 2, so that's like 40,000. Then we have to pay taxes on the rest. I put this out of the estate immediately. I didn't touch it, so I don't have to pay on that amount. And I made the chart a little bit colorful here, so it kind of looks like a rainbow. So the first year of taxes, I owe 8,400, then 6,736, 5,005, goes down to 3,205, and then 1,333. And then our tax liability is paid off. And here's a printout of the same. Okay, so it could go for 20 years if you're paying less. Like if you don't have these exemptions here, the time to pay off those estate taxes will take longer. If you don't have that, it's going to take longer. But we had some benefits there, so it helped us to get into the black quicker. Okay, so wrapping up here, effective financial planning has several key benefits, including better control over your finances, clearer goals. You set goals, you establish your goals, and you reach your goals. Ability to navigate unexpected challenges, and there's no gotchas at the end, right? You're planning for everything, and you can anticipate everything, right? You have a comprehensive plan. Individuals can allocate resources effectively, reduce debt, save for the future, and invest wisely. Okay, that is very important. Invest wisely. It provides a roadmap for achieving both short-term and long-term financial goals while helping mitigate the risks such as unexpected expenses or market fluctuations. Unexpected expenses could be an insurance incident, your house gets destroyed or partially destroyed, a car accident, health condition, something like that, that can derail your financial plans really quick, right? So you want to have the proper insurance in place. And that is pretty much it, guys and girls. So hopefully that was beneficial. Hopefully you learned a couple new things. I learned a little bit putting this together. Actually, my first job out of school was financial planner. It was all salesy, lots and lots of sales. It wasn't a whole lot of planning, and it wasn't very technical like this stuff is. I really like this kind of stuff. It was all salesy and just meeting people and shaking hands and trying to create relationships. It really wasn't for me, so I didn't last too long. But I like the concept of financial planning. Just to work in a sales environment wasn't really my cup of tea, so I moved on pretty quickly. But I learned a ton. Hopefully, you guys learned something here in this exercise today. So I'm going to wrap it up here. I will post the video in just a bit, and I'm going to share all the notes with you too. Okay, so hopefully this was a good opportunity to drop some knowledge, and hopefully you guys can absorb some of this knowledge for your own benefit. Okay, thanks for everything, and have a great day. Goodbye.